Our speaker today, Arthur Kroeber, I think probably many of you have already met him, or at least certainly read his name. At GaveCal, he has been one of the real pioneers in trying to explain the Chinese economy to a broad audience, not just of economists, but the financial community and elsewhere. He has a quarter century of experience in China. He's now going to be doing some teaching as well at Columbia as he tries to really bring an international understanding of China and bring the understanding of China to the world. With that, let me give you Arthur. Thank you.
Thank you very much, Keith, and it's great to be back here at the FCC. My task today is to condense 35 years of economic history, 20 years of economic forecasting, and 250 pages of my book into 20 minutes, which is a bit of a challenge. We will have some time for questions and answers afterwards, as usual. But I urge you, if your question is not addressed or answered, you'd be glad to know that my book is written in Q&A format, so you can pick up a copy of the book, flip through, find your question, and get the answer, even if I can't give it to you in person today. So what I want to do is very briefly summarize the perspective I have on how China got to where it is today, and then spend most of the time looking forward to some scenarios about how things might play out over the next 5 to 10 years. And the key elements, I think, of China's extraordinary success are, number one, it's kind of the best student of what might be called the East Asian developmental state model, which was the model that Japan, South Korea, and Taiwan used to industrialize very successfully after World War II. China borrowed this model with a couple of wrinkles. One was much heavier reliance on foreign direct investment than the others, and the other was much heavier reliance on state-owned enterprises. And I think both of these characteristics tell us something about the political constraints within which China operated its economic development strategy, and I'll get into that more in a little bit. And I think that also, this is important for understanding, those political constraints are important for understanding how things develop from here. The other thing that, of course, that's very interesting about China is that it's not just an East Asian developmental state. It's also what people in the economics call a post-communist transition economy. So an economy that's moving from a command economy where the state owns everything to a more mixed economy where there's much more private ownership and use of market resources. And then the final sort of key characteristic is that China, I think uniquely among nations in the world, and certainly uniquely among major economies, has a sort of a combination of highly centralized and highly decentralized political organization. And what this does is it enables, when the state needs to do something like build an interstate highway system or a high-speed rail network in 5 years, they can mobilize the resources to do that. But at the same time, the ground-level decentralization means that there is a lot going on among private entrepreneurs and small-scale businesses that really is outside the ability or interest of the central government to control. So you have a combination of these three broad elements, a successful strategy based on essentially industrialization and export-oriented manufacturing, a successful gradual transition from state control to private control, which means that a lot of productivity growth can come simply from the reallocation of resources from a relatively less efficient state sector to a more efficient private sector, and this unique combination of centralization and decentralization, which enables you both to get an extraordinary level of basic infrastructure development and a high degree of dynamic private sector entrepreneurship. It is really, really important in my view, and I think everyone in this room, I'm kind of preaching to the choir here, to understand the political context for all of this. I'm not a Marxist. Marx believed that the economic substructure determined politics. I think it's the other way around. I think political bargains in society determine and constrain forms of economic development. And there are two key elements in China that I think it's important to keep in mind. One is the domestic tension between the mandate that the Communist Party has set for itself to have a monopoly on power forever, and the mandate that it has also set itself to maximize economic growth. There are these two goals. One is slightly ahead of the other, but they're both really crucial. And it's important to understand this because there are a lot of authoritarian states, or even non-authoritarian states, where maximizing economic growth is actually not one of the priorities of the lead. And I think for many decades, India was a great example of a big country where this simply was not what the elite was interested in. So China is a case where there is a desire to maintain the one-party state and a desire to maximize economic growth. And the problem is every so often these two objectives collide, and you have to decide which you're going to favor. And the trade-off that's always been made in China is that, at least since 1979, when Deng Xiaoping started the reform agenda, was that when push came to shove, the party was willing to surrender bits and pieces of political control over state-owned enterprises, over trade, over manufacturing, over prices, et cetera, in order to generate economic growth, because it recognized that in the long run, its political power and legitimacy was enhanced by economic growth. So some tactical surrender of power was useful for the long-run power goal. And I think one of the characteristics of the reform era since 1979 is just how often those kinds of trade-offs have been made and how successfully. And I think one of the big questions hanging over China today is whether the current leadership under Xi Jinping is really interested in making that kind of trade-off. And I think there's a lot of reason to think that they're not. The second big political constraint is that unlike its East Asian predecessors, China is an independent geopolitical actor. They are not part of the US security system, and they have to take care of themselves. And I think there are two basic consequences of this. One is that this helps explain why China was so welcoming of foreign direct investment in the early stages, because they didn't get the deal that Taiwan and Korea and Japan got, which was they became part of the US security cordon in the Asia Pacific, and they were able to run closed economies with very great access to the US market. In order to get into the US-led global economic system, China had to pay some other kind of price of admission because they weren't part of the US security system, and access to the market was the price they were able to pay. I think the other obvious implication is that today we see that China is in a very different position than these other Asian countries in terms of wanting to translate its economic growth into a very, very autonomous political order in the region. Okay, so with that as background, if we look ahead, what are the key problems that China faces? And I think you can characterize these in three broad baskets. And economically, the key challenge is to undergo a transition from what I call a resource mobilization, or if you will, a capital accumulation form of growth, to an efficiency form of growth. And what I mean by this is very simple. Since 1980, the main job of the Chinese economy has been to accumulate the capital stock, the infrastructure, the housing, the factories, the industries, that are the skeleton of a modern nation, a modern economy. And when you're just trying to build up your capital stock and you get a lot of growth simply by throwing more capital resources into the system, state actors, state-owned enterprises, and a strong government can be very, very effective at this because they're not concerned with short-term financial returns. They're just willing to put a lot of inputs into the system in the knowledge or the belief that this will reap long-term dividends, and they don't need to worry about their quarterly financial statements. So that works quite well. The problem is that inevitably you get to the point, and China is more or less at that point now, where you've built up the capital stock of a modern nation, and you don't need to add more capital resources. Instead, you need to maximize the return on the capital that you've already installed. And in that situation, state actors are much, much less effective because they just have too many mandates to worry about efficiency. So this move from a capital accumulation to an efficiency economy really requires a big reallocation of resources away from the state into the private sector. On top of this, you have a demographic transition that everyone is pretty familiar with, namely China's getting older. I'm not sure that people quite know the scale and speed with which this is occurring. So if you look at the ratio between non-working ages, young people and old people together, as a share of the working population, that fell in half between 1975 and 2010. What this meant is that you had a much larger share of your population working, being productive, very few calls for social welfare payments and so forth, and so you could build up a lot of savings and generate very high economic growth. We're now on the other side of that curve, and over the next 30 years, China's demographic age structure will transform into something that is very similar to Japan's today. And just as Japan has found it difficult to generate growth in an aging society since 1990, China will have the same problem. And then I think the third one is in some ways the trickiest, in that both of these transitions require the governance system to change into a more flexible, responsive, and inclusive system. I think in principle this could all be done under the aegis of continued one-party rule by the Communist Party, but actually making that happen I think will be extremely difficult. I'm just going to show very briefly a few pictures to illustrate some of these ideas. This illustrates the change from a capital accumulation to an efficiency, or the end of the capital accumulation phase of growth. The blue line here is a picture of housing construction in China, and you can see that this annual housing construction has risen every year pretty much since the early 1980s, and it's been particularly fast in the last 10 or 15 years. But you can see it's now started to flatten out, and our work suggests that over the next decade, housing construction will have to fall by about 15%. And you can apply this logic to essentially the entire infrastructure complex. You've had a 30-year period where every year you had to build more infrastructure, housing, whatever, than the year before, and now that period is over, and the annual requirement of building stuff will decrease. So that tells you that you are at the end of a particular stage of economic growth. This is the demographic transition that I talked about, and the red line is this dependency ratio, the ratio between non-working age people and working age people. Very steep decline, very rapid increase starting a couple of years ago and for the next 30 years. And then when we look at this efficiency question, we have return on assets in industry for private companies in blue, state companies in red. And again, what this illustrates is that up until 2008, although private companies were consistently more efficient, delivered a higher return than state companies, the gap was not very large, it was very static, and the financial performance of all firms, state and private, rose together. Since 2008, that has changed. Private companies continue to do well, state firms very, very problematic and have seen a deteriorating return. So again, this reflects that during that capital mobilization phase of growth, state firms could be very effective economic agents, and now that you are in a more efficiency-oriented phase of growth, the state-owned enterprise sector is more of an albatross around the neck of the Chinese economy. So confronting these transitions, we have a government that outlined, as you're all aware, a fairly ambitious economic reform program in the so-called third plenum decision or resolution 2.5 years ago. Unfortunately, progress on many of these reforms has been pretty limited, and I think at this point we are in the political cycle, we're at a stage where the main objective of Xi Jinping and his colleagues is to get to the next party Congress in the autumn of 2017 with as little disruption as possible. So that means stimulating the economy with more credit to keep it on an even keel, and avoiding any big-ticket reforms that would cause a disruption ahead of that very important political event. So a lot of reforms have been identified, very few have been executed. It seems that there will be some delay in implementation because of the political schedule. And so therefore, where does this leave us in terms of how China might grow over the next decade? And fundamentally, it comes down to, I think, a question of whether at some point in the next 3 or 4 years, you get much, much more aggressive economic reform activity or not. And depending on that, how that plays out, I present to you 3 potential trajectories for Chinese growth, or scenarios. Now, any of you who've been involved in scenario planning exercises know that the one thing you know for certain about any scenario is that it will never occur, because it's a artificial construct. But hopefully this is a good way of organizing our discussion of things. So a successful scenario I describe as Singapore on steroids. And what this means is that basically the Communist Party achieves its aims of doing enough economic reforms, streamlining the state-owned enterprise sector, fixing the problems in the financial system, deregulating some of the regulated markets, particularly in services, to allow more private sector competition. And as a result of all of these reforms, manages to stabilize the debt by 2020 and stabilize economic growth at something lower than we're seeing now, at least officially, but still a pretty healthy number of 5% or so. So right now you have debt-fueled growth that's a bit higher, and the ideal would be to get to a somewhat lower level of growth that, however, does not require huge infusions of debt to keep on course. This would be a successful scenario for China. I think in terms of the international political environment, this might be challenging because, as we've already seen, a successful, economically successful China is also an internationally more assertive China. So I think there are some international relations implications of this that are tricky, but from a standpoint of Chinese welfare, this obviously would be a very good outcome. I think there are a couple of other ways it might play out. But basically, if you have economic reforms that do not succeed, I think there are actually 3. There's one that I didn't put in here. There's 3 ways they could play out. One is that the financial system blows up. And this is what I think a lot of the hedge fund community spends its time worrying about. For various reasons, basically the state-owned and highly liquid nature of the financial system, I think this is a fairly low probability outcome, certainly in the short term. And we can discuss that later if you want, but I kind of leave that off the list. I think there are 2 other outcomes that we need to consider in a sort of failed economic reform situation that are more interesting and more likely. One is a retreat to nationalism, and this would be the economic reforms fail, and China turns into something along the lines of Vladimir Putin's Russia, where you have an authoritarian state that no longer is able to establish legitimacy based on powerful economic growth. So the way that they assert their legitimacy is by much more bellicose and assertive nationalism played out internationally. And there's a lot of thinking in Washington now that is along these lines, that this is a scenario that we need to be concerned about. I actually think, though, that the more likely than that, and more likely than the financial blow-up scenario, is what I call the Japan 2.0 scenario. And the basic starting point here is the observation that there are certain clear similarities between the situation that China is in right now and the one that Japan got itself into in the late 1980s and 1990s, the big buildup of debt, and this alliance between a bureaucratic state and very large enterprises that economically wound up past its sell-by date, but then proved very, very difficult to disentangle. And just as Japan in the 1990s was unwilling to do the kinds of market-oriented structural reforms that would allow some more bottom-up dynamism to flow through the economy, China, because of this relationship between the Communist Party and the state-owned enterprises, could well wind up in a similar kind of situation. But rather than responding to a stagnation of economic growth by assertive nationalism abroad, I think the party more likely would become obsessed with maintaining domestic political stability and would employ a lot of the same mechanisms that Japan has in terms of continued state-led infrastructure investment to keep up investment levels and employment levels, probably a wider swath of social welfare spending and so forth. So I want to spend just a few more minutes exploring this particular scenario before we open it up and try to throw out some ideas about the similarities and differences between China today and Japan 25 years ago that hopefully will be helpful as you try to make your own decisions about where China is headed. And when we look at this comparison a little bit more carefully, what we find is that, okay, yeah, it's true that if you look at the debt levels and if you look at this need to change the growth model problem, China looks in many ways a lot like Japan in 1990. But then if you look at other dimensions, the similarities are still there, but they refer to earlier time periods. So the demographics in China are not great, but they're better than Japan's were in 1990. They're more like Japan in the late 70s or early 80s. And developmentally, if you look at average incomes, technological levels, and any sort of estimate of potential growth rate, China is much more like Japan in the early 1970s. And essentially what this means is that although there are certain challenges that China faces that are analogous to what you saw in Japan in the early 1990s, the resources, the potential growth, the dynamism, and the flexibility in China is much greater. Yeah. So again, just a few pictures to illustrate this. These show growth rates of a set of East Asian economies according to how rich they were. So as you go rightward on the chart, you're richer and richer, and your growth rate goes down. But what you note is that most of these economies, even if after they were much richer than China, were able to sustain growth rates of at least 5% for a decade or more. So potential growth is there. China, again, demographically, today this is a ratio of workers to retirees. It looks about the same as Japan in 1980. That's good. What's not so good is in that 25 years it will look like Japan today and worse than the United States. So there is some demographic wiggle room, but that window is closing fast. And then, of course, I think any of you who've followed the headlines or news about China's financial sector don't need to be told that China has a big debt problem. So there are some similarities, some differences. Clearly, the structural challenges that China faces in terms of the need to fundamentally transform its growth model are very great. And the political constraints, the domestic political constraints to making that transformation are enormous. However, China does have greater potential growth, more bottom-up dynamism, a more fragmented system. This gives hope that even if policy gets mismanaged at the top, that there is more of an opportunity for growth to bubble up from the bottom. And just two final observations about, I think, key differences in this comparison. One is that it's important to remember that Japan's problems in the 90s were triggered by a truly catastrophic fall in asset prices, about a 75% decline in equity and land prices in the space of 3 years in the early 1990s. And this wreaked havoc in corporate balance sheets and in the financial system, and it was very difficult to deal with. China has some imbalances, but it has no imbalances of that scale. So again, there's more room to maneuver. And finally, this gets back to the point I made earlier about China's independent geopolitical stature. For Japan, at the end of the day, it was an okay decision to say, well, we're just not going to grow anymore because it's too inconvenient to do the things that we need to grow, because we're a rich country, everyone's pretty well off, income is equally distributed, and our security is ultimately taken care of by the United States. For the Chinese elites, those options are not open. You've got a more tenuous hold on legitimacy for the political system, much more unequal incomes, a lower level of income overall, and a real need to take care of your own security. So there's strong incentives at the end of the day for the government to get the economics right, even if it looks like at the moment they're not terribly interested in doing that. So I think that is a good point to stop. And should I stay up here or?
It's your choice.
Okay.
First stay there, or?
All right. Maybe I'll join the moderator at the table, and I think the moderator is going to exercise his privilege and ask the first question.
So you say that China faces no such similar asset price collapse. But if you look at, for example, surveys of household asset composition in China, it is overwhelmingly concentrated in real estate, like 85%. And we keep hearing worries about real estate prices. If you look at it as a multiple of household income, it is extremely high by international standards. If you also look at where the leverage has gone from the banking system in the last 5 years, it seems to be shifting more and more towards real estate and less into other productive assets. So why, maybe it's not 75% in 3 years, but is China vulnerable to a real estate fall that would also have a lot of collateral damage on the financial system?
I think it's an entirely different situation. For one thing, if you look at prices, so famously in Japan in 1990, the land under the Imperial Palace in Tokyo was worth more than the state of California. House prices in Beijing and Shanghai, for the most part, are still below the house prices in Hong Kong. So you have, and actually average incomes in those cities are not that far off. If you look at house price to income ratios in China, they've been falling for most of the last decade. And they're not actually, in most cities, out of line with averages in East Asia, where the multiples tend to be much higher than they are in Europe. So no, we see basically no evidence whatsoever of systemic, large-scale mispricing of assets. And in the household sector, the other important thing is that households borrow very little. So even if house prices fall, household balance sheets are not really affected. So I think, if I feel pretty confident in the notion that the kind of catastrophic asset price contraction you had in Japan is just not on the cards for China. You could have a situation where there are a lot of developers that have borrowed a lot of money to build projects that don't make much sense. You could have a property downturn where a lot of these guys go bankrupt. They then cause stress in particularly the city commercial banks that have really stretched their balance sheets to lend to a lot of these real estate projects. So you could definitely have some financial problems and localized financial crises, but it would not be anywhere near the scale of what you had in Japan. So I think that there are a lot of problems in China. I don't want to minimize them. And I think there is rising stress in the financial sector that looks quite dangerous on a 3 to 5 year time horizon. But I think the particular type of trigger that you had in Japan in the early 1990s simply does not exist in China.
Thank you. What about the risks that some people perceive of a sharp fall in the value of the currency against the dollar, either through policy action or through some kind of disorderly route if there's too much capital outflow? Do you see that as a risk factor in the coming year?
I see that as a pretty low risk factor in the coming year. The first thing is that any serious valuation exercise, I think, will come up with an indication that the renminbi at its current value is roughly in the right ballpark, right? China continues to be very competitive in terms of exports. It continues to pick up global export market share. So we have no evidence that it's overvalued on that basis. So we don't have a large-scale misalignment in the undervalue in the value of the currency. We did obviously see a lot of capital outflows last year. A lot of this was corporations adjusting their balance sheets one way or another, paying back debt or simply shifting deposits from renminbi to dollars. just because they anticipated some movements in the currency. So it was not capital flight in the sense of people packing up suitcases full of money because they thought the roof was going to cave in. It was rational hedging behavior by corporations, and that is to a degree self-limiting. So yes, we could see a return of that hedging behavior if the dollar starts to rise substantially, which I don't think it will, but if it does, then corporations will start to hedge. That will put downward pressure on the currency, and the renminbi will have to depreciate a little bit, but it doesn't have to depreciate by all that much to reach a kind of a parity. So I think there is some risk there, but I don't see this as sort of like a an Armageddon scenario or something that could really systemically cause a challenge for the Chinese economy.
Okay. With that, why don't I throw it open to questions from our audience? Who would like to ask the first question? Please identify yourselves. And yes, we have one over there, please.
Hi, thank you very much. I'm Janelino from the Australian Consulate. I think there is a broad consensus on the conclusions that you have there on the screen about how China cannot just opt for genteel retirement. I mean, obviously, lack of growth will mean that at current levels of income, a lot of hardship for a very large number of people. One of the things that we have observed, particularly over the last 12 months, is a tightening of space for criticism and dissent of leadership policies, including from within the party. How confident are you that there are mechanisms in place for the authoritarian government to get the economy right, given that there do seem to be an increasing number of constraints on information getting to them?
Yeah, no, that's a very good question, and it gets to one of the sort of the central points in my analysis, which is that as I mentioned, I think one of the reasons that China grew so successfully for so many years was that the party was willing to make trade-offs of control, political control, in order to get economic growth. And the Xi Jinping government is very, very different. We've seen a complete, I think this is a bright line that you can draw between the way Xi Jinping is running things and the way that all of his successors, Hu Jintao, Jiang Zemin, and Deng Xiaoping, ran things. Much more emphasis on control. And I think there are two ways of looking at this. The optimistic view would be that the system had gotten so fragmented and out of control at the end of the Hu Jintao era and had become so factionalized that the political system was literally at risk of breaking apart. And I think among the party elites, that would be a pretty common analysis. And so what you needed in order to hold the state together was a re-centralization, a very comprehensive re-centralization agenda to centralize power, reduce the level of corruption, and make executive authority more effective. And so the logic of this is once you have achieved that aim, and this is an aim that obviously takes several years to achieve, but hopefully by the end of the next party Congress will be largely done, then you will have a strong executive that will be able to move much more aggressively on the kinds of top-level economic policies that are necessary to get the economy going, right? So that would be, I think, the positive spin on this way of governing. The negative one would be, as you suggest, that a modern economy runs on information flows and not just on top-down dictates. And so if you constrain space in civil society, in academia, in media, everywhere, and make it much more difficult for information to flow, then the chances that the guys at the top making these executive decisions get it wrong is increased. And I, frankly, am more in the latter camp. I think over the long run, unless we see some relaxation in these kinds of political controls and some willingness to create channels for information flow that are more flexible, you're much, much more likely to see mistakes being made in economic policy. And in fact, we've seen that, right? So last year was like a banner year of incompetence in Chinese economic policy. They messed up the stock market. They messed up a beneficial change in the exchange rate. And I think part of the reason that they messed up has to do with the way that they were getting in and processing information. So to be determined, but clearly I think there's a lot of risk to the long-term growth potential for the reasons that you mentioned.
You know, there's been this kind of post-Tiananmen narrative that the Chinese population was willing to accept the kind of clampdown on dissent and lack of personal freedom in exchange for having all this economic opportunity. If your scenario about this new normal of 5% growth is right, with the lack of the huge infrastructure spending that allowed so many people to get really, really wealthy, when does that trade-off start fraying? When do the public start really voicing that kind of resentment, either through public dissent or capital outflows and leaving the country?
Yeah, I think that's still a ways down. So first of all, yeah, you have lower investment rates, but employment has been doing fine. Wage growth has been doing fine. Consumption is doing fine. One of the biggest trends in China in the next decade will be the growth of affluent households, which have income of at least $20,000. Right now, there are 80 million of those households. Even under a more conservative, not quite Singapore success story, a growth scenario, we estimate that there will be 180 million of those households a decade from now. So a doubling in the affluent population of people who want to buy more healthcare services, more financial services, more trips abroad, more SUVs, and so forth. There are going to be a lot of winners who do not feel like there's anything wrong with what's going on. I think a lot of the sort of discussions about sort of the urban bourgeoisie, which is now the principal constituency of the China's Communist Party, and an interesting bit of historical irony. At what point did the urban bourgeoisie start saying this is no good for us and we want more voice? I think they don't really become very interested in upsetting the apple cart until they're confident they are a majority of the population. Right now, by the most expansive definition, they're like 20%. In 20 years, they might be 40%. If there were an election tomorrow, they would lose it. They would lose it to rural populists. They went through that with the Cultural Revolution. They have no interest in going back. So I think there are a lot of forces that suggest that social unrest from whatever venue is not going to be kind of the major thing. When I think of things going wrong in the Chinese polity, basically my theories all have to do with some kind of split in the elite. And then you have people taking sides at the top. They can't agree. They start fighting with each other, and then it all falls apart. I think that's much more likely than sort of a revolt of the middle class or anything like that.
Okay. We have time for one more question. Over here, please.
Recently, China has been very aggressive in demanding a market economic status. They say they're entitled to it. Based on your findings and your observations, what is justified?
Okay, well, so I will preface my answer by saying that you are referring to a very specific discussion, and this is not an economic question, this is a political question, right? So whether China is deemed to be a market economy under the WTO has nothing to do with what economists would say. It has everything to do with how important China's trade partners think it is to retain their ability to impose anti-dumping duties on China. So I'm going to dodge that question, but I'll answer a related one that hopefully gives you an idea. When I look at the global economic situation over the next decade and how that is likely to be affected and transformed by China's growth, and here the assumption is that China doesn't blow up and it doesn't stagnate tomorrow, but it continues to grow at a reasonably fast pace for the next 5 to 10 years and continues to push a lot of capital and companies abroad. And I think that's a pretty, under most parameters, that's pretty likely. Okay, if that happens, I think we've got a big challenge, because fundamentally the economic growth model that Xi Jinping has been setting up over the last couple of years is a highly mercantilist one, where he's saying we have very aggressive targets for Chinese companies getting market share both at home and internationally in a whole bunch of new high-tech sectors. We basically have no interest whatsoever in opening up our market further to foreign firms. So we want an asymmetric environment where Chinese companies pick up market share everywhere and no one else gets to pick up market share in China, right? And if they push this forward, and particularly if the vanguard of pushing this forward are Chinese state-owned enterprises, which are viewed not just as commercial entities, but as agents of a deliberate state strategy. I think the backlash from countries like the US, Europe, and so forth, which are experiencing low growth and a lot of backlash already against globalization and free trade, I think it's going to be very, very powerful. So I think even under variations of a successful China scenario, I think this becomes very challenging for the global environment, because China's success could well be bought at the expense of other countries who will find basically no recourse but to raise protectionist barriers against Chinese goods, and more importantly against Chinese investment. And that's basically what this whole market economy thing is about. That's the real substance of that question. And I think the implications of that question go well beyond this narrow question of does China get market economy status. I think it has to do with the entire global trade and investment regime, and can it withstand the kind of transformations that are going to be imposed on it by Chinese growth over the next decade. I think that's going to be very, very difficult to manage.
Thank you very much, Arthur. We like to always give our guests something to remember the club by, although you're not wearing a tie now, but in case for another occasion.
All right.